Now through May 31st, get access to 7 of our most popular products, spanning from crypto recommendations to free stock picks. Completely free for your first 7 days. No credit card required. Cancel anytime. See for yourself why more than 1 million people love Stansberry Research. Simply visit stansberryfreetrial.com.
Welcome to Making Money. This is Matt McCall. Thanks for joining me here today. It is the 10th of May, 2022. It's a Tuesday, and we have the market actually up today. And that's like an outlier the way things have been recently. We had a big sell-off late last week. We started this week a bit rough. We're going to talk about that. We're going to talk about the volatility, some stats going back. Not only are stocks falling, but bonds are falling as well as yields continue to move higher. Big stories out there in the market right now. It's time to take that zen and sit down, relax, close your eyes and meditate. Speaking of which, it is Mental Health Awareness Month. We're going to talk about that and the stocks that are really set to outperform, in my opinion, in the years ahead as mental illness comes to a height and more people are talking about it. All that and more coming up right now on Making Money. Again, this is Matt McCall. Thanks for joining me today. It is May 10th, 2022. It's a beautiful Tuesday here in South Florida. Hopefully it's beautiful where you're at as well. And we have the market actually up right now. It's only 10:15 in the morning here East Coast time, but we have the S&P up about 1.3%, Nasdaq doing a little bit better. But this is after some really ugly days. The last 3 trading days have not been good to the markets. And the S&P actually closed at about a 1.5 week high middle of last week after the Fed came out. We had that huge rally. We gave it all back. We talked about that last Thursday. Friday, we had some more selling. And then yesterday, Monday, was a very ugly day for the stock market. And we're getting a bit of a buying. Maybe it's a dead cat bounce, as they call it. I'll dive into that in a minute. But we did have the major indices close at the lowest level in over a year. So we are seeing 52-week lows. And you don't hear that often in the market, especially the type of market we've been in for the last several years. Taking outside of the quick sell-off we had when COVID started running rampant in early 2020. And again, long-term, the market goes up about almost 80% of the time, long-term versus going down. So the odds are the market will go back up, which I think it will. You know, as they say, the world ends once. And if the world ends, the world ends. You know, not much you can do about that. Same thing with the stock market. Pullbacks are normal. Bear markets are normal. Recessions are normal. All this stuff is normal. And I know me saying this doesn't really help much because it still hurts every time it happens. It feels like you're in a ring with Mike Tyson. You know, yeah, it's normal that he's going to punch you and get a couple punches in. You know you're going to be okay, but it hurts when he's punching you. Whether it be a gut punch or he hits you on an uppercut, it's going to hurt. And that's how it feels right now. It feels like you're getting punched in the gut and an uppercut. I mean, it is tough, folks, and I get it. I understand it. And really everything's getting hit right now. All asset classes are selling off. And it's really tough to watch your portfolio go down unless you're sitting in just pure cash. And if you are, congratulations, because you're going to have some of the greatest buying opportunities of the last 10 years in the next couple of weeks and months, I believe, because I think that we're really going to see some of these stocks at or near generational lows. I wrote yesterday in my daily email, which you should be signing up for. It's free. I wrote yesterday in the daily email about PayPal. You know, PayPal was a stock that was above $320 and then pulled back below $80 yesterday. Right now it's sitting at $80, but from $320 down below $80. Its price to sales ratio, it's a nice valuation, how to value a company, the lowest level we've seen in over a decade. I mean, you're seeing the stock value at the lowest level ever, really. So you look at something like PayPal, and I say to myself, well, is the fintech mega trend over? No. Is PayPal suddenly not going to be a leader in that? No. So again, was it overvalued at 320? Sure, you can make the case for that. But now it's trading at forward price to sales about 2.0, which is less than the overall market and it has much higher growth than the overall market. Again, I'm not saying go out and buy PayPal right now. Nothing here is a buy or sell recommendation, but it just was an example that came across my desk when I was looking at stocks yesterday. The thing is, folks, it falls from 320 to 80 in 1 year. 1 year. When it's at 320, if I would have told you, you could buy PayPal right now at 250. If it pulls back to 250, you'd be loving it. You say, I'll take it all day at 250. Now it's at 80 and you're scared to death. That being said, could it go to 60? Sure, I don't know. But I do think at some point is well back into the triple digits. And even if it gets back to 160, which is still half of what it was at its high, that's a double from here. And how often you get doubles that quickly? No, you don't. So again, I think there's a lot of PayPals out there right now, in my opinion. But let's take a look at the S&P 500 here and just kind of show you what I was talking about here in the charts. And as you can see, we rallied here. This was Wednesday when the Fed came out with their decision. Obviously, it was kind of in line with what a lot of people believed. And then we had a sell-off on Thursday. Friday sold off a little more. And then yesterday was ugly, going down to a 52-week low. And as I mentioned, bouncing back today. It's still early, folks. We're less than an hour into trading. It's up 1.4%. Let me take a look at the NASDAQ 100. The Qs are up about 2.4%. Very similar chart. Hit a 1 week high. Then we sold off 3 days in a row. It's up a little more because it's been a little more volatile and the sell-offs have been more accentuated. So you're going to see a bigger move higher when it comes to the Qs here. The way I look at the market here right now is it's tough. And I talked about this the last couple of weeks. I said, long-term, I'm still extremely bullish on the roaring 2020s. I'm extremely bullish on disruption and innovation and what I call the flippening of how things are going to change in the next 8 to 10 years plus. That being said, in the near term, stock markets are irrational. They don't make sense. Whether the stocks are rallying to new highs or falling to new lows, it doesn't make sense a lot of times. Over time, rationality comes back and it pays off. And the fundamentals come home to roost. If you don't have good fundamentals, you're not growing your top line, bottom line, you're not making money, your stock's probably not going to go higher. But we look for stocks that have great growth, top line, bottom line, either making money or what I call a path to profitability, and are in trends that are going to move higher no matter what. There's going to be more EVs on the road. There's going to be more demand for batteries out there. There's going to be more AI, artificial intelligence, VR and AR, virtual reality, augmented reality, continue to move forward. So you want to be investing in these trends that you know are going to be moving forward. Could the growth slow at some point along the next 10 years? Yeah, nothing goes straight up. But the odds of them moving forward are 99%, if not higher. So that's what we want to look at. But I got a bunch of charts here I want to share with you today, just to kind of give you an idea of where we are in this market right now. And this one's kind of fascinating. And this one shows historical drawdowns going back to 1976 when they started keeping records. And it shows historical drawdowns in the orange. It's the Bloomberg Aggregate Bond Index. So it measures U.S. bonds, government bonds. And the blue is the S&P 500. It's crazy. I was born in 1976, and this is the first time they had these numbers. So the first time in my lifetime right now that the drawdown from a high of both the bond index and the stock index are both over 10%. This was coming into the week. The bond index was down 11% and the S&P down 13% from a high. It's the first time both have been down over 10% at the same time. You can see there's all kinds of drawbacks going back 45 years or 46 years. I forgot how old I am sometimes. 46. I think I just told somebody yesterday I was 45, believe it or not. I guess when you get to this age, you just stop counting. So down 30% here going back. This was 1987, which was, obviously Black Monday when that happened. We did the tech pullback. Then we had the great financial crisis. Typically during these times of pullbacks, bonds actually do well. So let me show you that chart because this is pretty interesting here as well, that how this is such a different situation right now. Look at this. Again, going back to that same time frame. You can see when the S&P pulls back, typically bonds do very well in these time frames. When you have ugly starts to the year, this is an ugly start to the year through the first 4.5 months or so. This year, the S&P is down 12.9%, but the bonds, this was about a week ago, down 9.5%. Normally, when you have a terrible start to the year, going back again, 46 years, bonds are up every time, or at least flat. Not this time. You can see right here that bonds are actually down as well. That's because interest rates are moving higher. And you rarely have interest rates moving higher when the stock market's pulling back. So it's a weird situation. I don't ever want to say this time is different because that gets you in trouble. But this time is a bit different. I think every time's a little bit different. I love history and looking back because this is all driven by psychology. But as you can see on that chart I just showed you, we are in rarefied situation right now. And to add all that to all this right now, I want to look at the AAII, the American Association of Individual Investor chart. And I talk about this a lot. It comes out every week. And if you take the amount of bulls, it's obviously 0 to 100, percentage of bulls, and you minus out bears. And you want to see what that level is. So it's negative right now because there's a lot more bears than bulls. And I'll look at this chart, folks, down to negative 43% in the last reading. The only other time that we've been more fearful as individual investors was at the great financial crisis, which I just showed you. And at the going all the way back, believe it or not, to 1990. We had a quick bear market in 1990, but even more bearish now than we had in the tech bubble. In the tech bubble. That, again, it shows the mentality out there right now. And I've been in this business for 20 plus years, talking to individual investors, whether they've been my clients, whether it's subscribers, whether it's people when I go out to a restaurant or a party or just friends at the beach, wherever it might be. Always talking markets. People ask what I do and I get fascinated. They always ask me. And this measures the average retail individual investor out there. And when most people are extremely bullish, it scares me a little bit. When people are asking, from the street, people you never even thought would ever invest in stocks are asking you to buy Bitcoin, it's a bit scary. When people are asking to buy the quick get rich quick stock, it's a bit scary. But when people are this fearful, even though unemployment is near a historical low, even though there's about 15 million jobs available, it's scary. And the reason is, I blame a lot in the media, but things are a bit scary because prices keep going up. Egg prices over the last year up over 90%. Milk prices over the last year up over 35%. So those things that you go and buy are going up. Used car prices, even though they've come down quite a bit in the last 2 months, way up over last year. Home prices, as we know, way up over last year. Mortgage rates now spiking, making homes less affordable. So a lot of things that we see and feel are more expensive. Even though wages are going up, they're not going up the same pace as inflation. So I look at this, and if the Fed can continue to raise rates at a nice pace, and again, I'm putting a lot of faith in the Fed here, which who the hell knows what they do, but continue to raise it at 50 basis points, and it does start bringing inflation down. I think inflation's peaked personally. I think energy has peaked. I think a lot of food prices have peaked. I think housing prices have peaked in a lot of areas. You'll start seeing that come down. Rents have peaked in a lot of areas. As that happens, you'll see inflation come down. So I think we're there. I'm not saying inflation goes from 8 and change back down to 2 anytime soon, but I think we're going to start drifting lower, which higher interest rates should help that as well, which should make us start feeling better. But again, going back to that chart I just showed you, when people are this bearish, it is typically a great buying opportunity. And I'm not saying today, I'm not saying run out and buy everything today. I'm saying that we are in a bit of a sweet spot. Could we go another 10% lower in the S&P 500 and Nasdaq? Sure, it wouldn't surprise me that much. That being said, there's a lot of stocks. Again, I'm using PayPal just as an example because I talked about it. At $80, I think PayPal is a great buy for the long term. If you have a 3 to 10 year outlook, 3 to 5, 3 to 10 year outlook, I think that's an easy double from there. But again, could it go from 80 to 60 before it goes to 160? Yes, and it wouldn't surprise me because when that pendulum swings from severe greed to severe fear, it can swing very far. And we're seeing that right now. I think we're very near that level of that pendulum is going to start shooting back and at least get back to the middle, whereas a fair valuation of PayPal is probably around 160. Not 80, not 60, not 320, but maybe around 160, which again is a double from here. All right, folks? All right, so that's where we stand right now with the markets. A few other things I want to talk about. Bitcoin. You all know I like Bitcoin, but Bitcoin has gotten absolutely shellacked. And it actually fell below 30,000 in the last 24 hours. Right now, Bitcoin, and it dipped below it for literally minutes, but Bitcoin right now is sitting at about 32,000, give or take. Still well below, down over 50% from where it was, a hot all-time high last year of 69,000. Again, I said this for years, that I still think Bitcoin hits 100,000, 6 figures, but I always said it could hit 30 before that. I don't know, but I'm in for the long game. And I have studied the stock market as much as anybody. I will say that. I'm not a billionaire. I don't manage billions of dollars. But I will say that I can confidently sit here and say I've put as much work in as anybody for my age. Maybe people who are 90 did twice as much because they had twice as much time to do it. But for my age, I have studied the stock market. You should see. I had a friend come over the other day and laugh because I had a stack of books on my little table in my living room. And they're like, "Oh, you trying to look smart?" I said, "No, I actually read all these and I reread them because history does repeat itself and the stock market is driven on psychology. So if you could figure that out, it works. And the one thing that I do know is that you invest in good companies for the long term, you will make money in a diversified portfolio. You will. You absolutely will. And if you don't 10 years from now, this world's in the shitter. And there's probably bigger issues than the stock market and money at that point. And that could happen. But again, I can't invest for that because the chance of that happening again is so slim. You got to play the odds, folks. And the odds are you hold on long term. The other thing I want to talk about is just, we talked about bonds already, but the yield on the 10-year. The 10-year yield right now, I'll pull this up on a chart for you, is sitting around 2.967. Keep in mind, it was about 3.15 just yesterday. You can see how it's really crashing down. And that is sending the bond ETFs higher. And here's TLT, as you can see, up 1.3% today, trying to bounce off a low. Could yields be topping out? That could be a good thing for the market if it is. I don't know if they're topping out. I think we priced in a lot of interest rate hikes as of right now. And I think we probably stay in the low threes. I don't see you going above that anytime soon. But again, that's something to keep an eye on. So today, the topic I'm going to talk about, it is Mental Health Awareness Month for the month of May here. And this is something that is near and dear to my heart as someone who struggles with mental illness. And the awareness that has come out over the last couple of years as athletes and celebrities and CEOs and people who have clout, let's say, have come out and talked about their struggles. There's also the COVID government-enforced lockdowns that forced a lot of people that rely on going out and talking to people to stay in by themselves. So, and it really led to, unfortunately, a spike in mental illness. It led to a spike in suicides, and it's completely sad. And this was caused by the government and governments around the world, in my opinion. Just a couple stats here. This has to do with a lot of younger people. And I'm going to talk about stocks and companies that are going to play off this and have great upside potential. So the CDC says that 37% of high school students report that they have regular mental health struggles during COVID. That's over 1 1/3. That's a high number. And again, at that age, it's something that should be met with some type of treatment or help immediately. The U.S. Census Bureau, National Center for Health Statistics, showed that more than 4 in 10 U.S. adults developed symptoms of depression and anxiety by the end of 2020. Again, what happened in 2020? Government-imposed lockdowns. Complete BS. In 2019, 1 in 5 adults in the U.S. lived with mental illness issues. And those are people that actually admit to it and diagnosed with it. There's probably a lot more. I got a couple charts I want to show you that I use for writing my book on this. And we'll just fly through a couple of these. Here's the first one. This is showing how the pandemic has taken a toll on families' mental health. And it shows the percentage of U.S. parents who describe the following groups' mental health as good now versus before the pandemic. You can see children before the pandemic, 83% good, down to 68%. Other family members, 78%, down to 60%. And themselves, 75% to 50%. So again, you're seeing how this pandemic really, really led to a massive spike in mental health issues. Here's another one that I think really brings this home. This shows how the pandemic caused a spike in anxiety and depression. And it shows the percentage of U.S. adults that show symptoms of anxiety or depressive disorder, which I struggle with. And it goes back to the 2019 levels. Look how low these are. This little dotted charts here. Then it shows June 2020 through December 2021. The only good news is they're a little bit lower than the spike that we had in December of 2020, but still so far above where we were prior to the pandemic. It really has brought, a major issue into the mainstream, which I hate to say this, but part of that I do like, and because now people are actually getting help for this. And you're seeing companies go public. You're seeing a lot of companies shift to helping this. And the last one I want to show here too as well. Again, this is going back to children. Parents who see COVID as a major threat to kids' mental health. And you can see here, what is the state of COVID-19 was a number one threat to kids' mental health. Well above bullying, almost double what bullying is. And again, I hate to just pound COVID and government shutdowns, but this stuff's real. It has caused it. And this is a real issue right now. There's a lot of, the amount of people I know that deal with mental health issues, and a lot of us do. I surround myself with a lot of type A people that are successful, and a lot of us deal with it. It's just how your brain is wired. So maybe that's why I know a lot of people that deal with it. But I also feel like because I'm very open with it in the last couple of years, that a lot of other people have opened up to me. And I love being there for people. In a few hours, I'll be on my weekly call with my psychologist. And we talk and how the week going, talk about things. And I think therapy is something brought up as a male in a low middle class blue collar family. You didn't say you had mental illness. You couldn't say you were depressed. You couldn't say you had anxiety about doing things. It just wasn't what men did. And that stigma is starting to change a bit, but it's still there. So if you need help, please reach out and get help. And if you want to donate, there's plenty of great organizations out there that you could donate to. So now let's get to the making money part, because obviously we want to make money and have some fun doing this. So there's a couple of companies out there, a few that have gone public as of late, that tackle the mental health issues, and not all of them have done well. The first one that I want to talk about, and this is a company that went public via SPAC about a year and a half or so ago, and this is called Talkspace. You may have seen some of the commercials. They did some commercials. You could download the app and you could talk to a therapist or psychologist through the app and set up meetings. And it's about a $200 million company. You can see back here when it went public via SPAC at $10, and it's really been going straight down. It's down to $1.19. This is the lowest, it'd be the lowest close ever for this stock. As I mentioned, about $200 million stock. It did revenue last year of $76 million. 2 years ago of $76 million. Last year, $113. This year, we're looking for $128 million. And then by 2024, just 2 years from now, $186 million. So you can look at it one way and say, well, trading on last year's numbers is trading at a price of sales of less than 2. So that's actually fairly valued in my opinion. But it also lost $1.10 a share last year. And that's the issue. And it continues to lose money through estimates through 2024. So even though sales are increasing up to $186 million potentially in the next 2 years, it would trade just over 1 time sales. That's a very attractive valuation. That being said, on the other side, it's not expect to make any money soon. And I talked about this just a moment ago. One of the keys to investing in small cap stocks is seeing a path to profitability. Talkspace does not yet have that path to profitability that I can find. So until I see that, I would stay away from the stock. And again, down at $1.19, there's a reason it's down there. There's a reason it's down 90% from its high. But they, just to give you a little bit about it, it's a virtual health company. And again, you can log in, talk to a counselor, a psychiatrist, psychotherapy. So I like the business model. Obviously, they're struggling to make money. It's early stage growth. Probably should have stayed private for a few years until they got closer to profitability. But again, just want to share that with you. Again, I'm not saying nothing here is a buyer's recommendation, but I would stay away from this one right now. Another one that went public not too long ago is LifeStance. LFST is a symbol on LifeStance. This went public via a traditional IPO in June of last year. It opened around $20 a share, ran up to nearly 30. It's then continued to fall. Now it's again at the lowest level ever today at $6, down about 3%. It's a $2.5 billion company. They provide both virtual and in-person outpatient mental health care for both children and adults on a variety of different conditions. They deliver personalized, data-driven, comprehensive care to help these patients. They have over 3,300 psychiatrists, nurses, psychologists, and therapists that use their platform that they can provide them with potential patients. Again, near the low of the day and low of all time. So this company had revenue of 2019 about $212 million. This year, they're looking for $667 million. Next year, 1.12, and then by 2024, about 1.4 billion. So it's got really nice growth. It is supposed to turn profitable next year. So again, this is one where it's got that path to profitability. It trades at a decent valuation based on its growth. But again, companies like this that are not mainstream, that it's still a small cap, in my opinion, at 2.5 billion market cap, it's flying under the radar. And again, I never catch a falling knife. I never try to buy at an all-time low and hope I'm the genius that's going to buy at the all-time low. I always let a stock build a base and start coming back up before I ever try to buy it on a pullback like this, especially one at an all-time low. Again, what are the odds of me picking an all-time low? Not good. So I'm probably going to buy too soon. I'd rather pay a little more for it and let it build a base and come back up. But again, very interesting company. It is battling something that is a growing trend, unfortunately, and it's one you may want to put on your radar. The third stock here I want to take a look at is Acadia Healthcare, and this is symbol ACHC. It's a bigger company than the first two, $6.4 billion valuation. It had sales of 2020 about 2.1 billion, 2024 looking about 3.1 billion. So the growth isn't as high as some of the others, but it's also making quite a bit of money, and the company's been around a while. It does behavioral healthcare facilities in both US, UK, and Puerto Rico. They have inpatient psychiatric facilities. They have specialty treatment facilities where they get most of the revenue. Their US facilities, they get a large portion of their payments from Medicaid, which, obviously that's the government-backed healthcare. Now look at this. This stock, as you can see here, is not far from a high. And I'm going to zoom out a little bit on it for you and even go a little bit further and just show you this stock. This is the highest level it's been 2016. So it's at a multi-year high just recently before it pulled back. So just a month ago, it was at about a 6-year high. Stock is pulled back with the overall market right now. It's making good money. In 2021, last year, it made about $2.70 a share. By 2024, 2 years from now, it's expected to make about $4 a share. So this is one where it's a more established company. The chart, obviously, as you can see here, looks much better. And this would be a much safer play versus the first two, in my opinion. And again, it's a direct play on treating mental health right now. So again, here in the US, Puerto Rico, and UK. So that's one I would definitely put on a watch list and keep an eye on, where I think you're going to have a much better opportunity with that company to, have upside, but again, not as much downside when you come to something like that. And there is one more chart here I want to pull up for you. And this is just showing the stocks that I just talked about. And this is going back year to date. And you can see up here is Acadia. This was as of before yesterday. So it's probably, these numbers are a little bit lower. But there's Acadia actually up 16% year to date. The S&P down 13. And then the other two, LifeStance down 29 and Talkspace down 34. So this is why you want to have a diversified portfolio. Let's just say in the beginning of the year, just for argument's sake, you bought all three of these, right? You bought all three of these and you put equally took those out there. And, you take a look at it and you have, so 29 and 34. I'm just doing math here real quick. And then 16. So you have about an average loss of about 15.5%, where the S&P is down 13.3. Whereas if you pick just one of these two down here, you'd be greatly underperforming. If you just pick one of these, a chance 1 and 3, you'd be outperforming the market. But that is why I build baskets. And I'm not saying build this basket by any means. That's not all I'm saying. I just took an example. If you would have built this basket, because I don't like Talkspace right here, or even LifeStance trying to buy at lows. But if you did, you still would be right around what the market's giving you because of that diversification of spreading out your money into more than just one. And that's why you build the basket. You basically build your own ETF these days in whatever trend that you're looking at. And a couple other players I want to talk about in this space, and people will bring up, well, what about, telehealth? Teladoc, which has been a company that I'd recommended many, many years ago. We took some nice profits in it. Teladoc, symbol TDOC, largest telehealth company in the world. They have obviously some exposure to telehealth as far as psychiatric and mental health treatment. So they are a potential player on this as well, and they have gotten beaten down a lot. Cannabis, there's some cannabis companies that are trying to get into using cannabis and CBD for mental health issues. And then there's the psychedelics, the mushrooms, the psilocybin, ketamine. You're seeing some, acid LSD, basically microdosing of it. I think there might be something there. We're not far enough along in the testing of it yet for me to back anything. But there's a couple companies out there, Cybin, which is CYBN, Compass, which is CMPS. Those are both companies in a psychedelic realm that are years away from making money, if they ever do, for approval. They're trying to get drugs approved by the FDA and over in Europe. So there are other ways to play mental health, the mental health megatrend, unfortunately. And I think it's maybe a little early right now, but if the market does stabilize, I think there could be a possibility out there for a lot of these stocks to do very, very well. But more importantly, if you're struggling with any type of mental health, please reach out. Don't be ashamed. Again, you can reach out to many places online that you're anonymous. Friends and family are always there for you. You could reach out to me. I'll be here for you. Reach out to me via social media if you have any issues, because we all have to be there for each other when it comes to this. And again, there's great places to donate money out there, or if you want to back this, they're out there. And again, maybe you'll make a lot of money off some of these stocks in the space, and you can help give those profits back to help others. So I want to thank you so much. And again, it's Mental Health Awareness Month, this month of May. So please be there for people if they reach out to you. And if you're somebody, please reach out to somebody else if you need help. But again, thank you so much. Let's just check the markets real quick before we get the heck out of here. And right now we have the S&P at the low of the day. It's only up 0.5%. So again, the buying's not holding on, and wouldn't be surprised if we close down again today. But I am starting to feel a bit of capitulation. I'm starting to feel that fear. Again, I'm not saying go out and buy today. I'm not at all. I'm saying that we are probably near a sweet spot on a lot of stocks out there right now. So start building your watch list of what you want. So when that buy signal hits, you're ready to go. Again, thank you so much for watching. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.